Okay, let's unpack this. Have you ever wondered why a highly celebrated trade agreement, specifically focused on American soybeans, could actually be, well, strategically deployed to completely mask a massive and growing national vulnerability, both in critical rare earth supply chains and, maybe surprisingly, in our own domestic financial plumbing?
It really is a classic case, isn't it? Political theater versus the structural reality underneath.
Right.
We've synthesized the latest reports, looking at the outcomes of these recent U.S.-China economic talks, and just as importantly, the simultaneous kind of quiet shifts happening over at the Federal Reserve.
So our mission today is what? To look beneath those headlines.
Exactly. Expose the very real structural weaknesses being papered over by these, frankly, temporary deals,
Right.
and try to understand what these short-term fixes really signal for the long-term economic stability of the U.S.
Okay. Before we really get into it, if you find this kind of analysis useful, maybe take a second to hit that subscribe button and support Geo9. It really helps us keep digging into these stories.
Yeah, definitely appreciate the support.
So let's start where the news seems positive, maybe down on the farm. We've seen figures like farmer Scott Besson celebrating what looks like a pretty major victory.
The numbers look big.
The commitment from Beijing is substantial, right? 12 million metric tons of soybeans this season, then a minimum of 25 million metric tons annually for the next 3 years. That's through August 2026.
It's a huge volume ramp up, absolutely.
Yeah.
Way above the average of the last 4 years.
So on the surface, that feels like a major win for American agriculture.
It certainly feels like a win for volume, but you always have to ask, right? At what cost? And is this commitment really market-driven?
What do you mean?
Well, what's fascinating here, and kind of telling, is that despite this massive purchase promise, China is still keeping that significant 10% tariff on all U.S. goods.
Huh.
So that means one of two things. Either Beijing is actively subsidizing its own importers to cover that 10% hit, or Chinese companies are just swallowing the increased costs themselves.
Which makes it a political decision then, not really an economic one based on market prices.
Precisely. It signals cooperation, sure, but it's a temporary concession, not a sustainable, long-term market solution.
And if it's political will, not economics, it's fragile.
Inherently fragile. Especially when you look at the competition. Brazil is just waiting in the wings.
Oh, Brazil.
Whoa.
The agricultural powerhouse.
They can scale production fast, and they have this critical natural advantage. Their cost of production is calculated to be about 10% cheaper than in the U.S.
10% cheaper. In commodity trading where margins are razor thin, that's absolutely massive, isn't it?
It's huge. So why would China, or any buyer really, choose the more expensive, tariff-laden U.S. product in the long run?
Plus, there's the whole BRICS angle. China prefers trading within that bloc, moving away from dollar transactions.
Exactly. Reducing reliance on the U.S. market over time. It all points away from the U.S. long term.
And if we zoom out, look at the bigger picture for U.S. farming. This deal, even with the big volume, it's really just a Band-Aid, isn't it? A massive one, maybe, but still just a Band-Aid.
It really is. Because the underlying economics for the American farmer right now are just terrible.
How bad?
Production expenses, think fertilizer, energy, machinery, everything, they've exploded. Up by at least 30% since 2020.
30%. Wow.
And that spike, it's a direct consequence of the monetary expansion from the Fed. Trillions injected, liquidity flooding the system, driving up prices everywhere.
And the tariffs themselves just add to it, right? Making inputs like machinery and chemicals even more expensive.
Correct. And the data on losses is just staggering. We're talking soybean farmers currently losing over $100 for every single acre they plant.
Losing $100 an acre.
Think about that. Yet selling more volume to China stops the beans from rotting in storage. That's obviously some short-term relief.
Sure.
But the fundamental business model, it's broken.
Yeah.
It remains utterly unsustainable.
So unless the government steps in with, like, permanent, massive subsidies.
Selling more just means losing more, faster. The core issue is a structural cost crisis. It's not about volume.
Okay, so we have this farm deal. Looks good on the surface, but it's temporary, political, and doesn't fix the underlying farm crisis. So what do the U.S. have to give up to get even this temporary relief, this inventory management solution?
Ah, that's the crucial question. What was the trade-off? It seems like there were concessions in two areas that are, frankly, far more strategically vital than soybeans.
Okay.
The first concession was basically delaying the enforcement of certain sanctions targeting Russian oil sales,
Yeah.
particularly to China.
China being the biggest buyer of Russian crude.
Right, ensuring Putin keeps getting that revenue stream.
Okay.
But the second concession, the one involving rare earths, that's the really monumental one.
Okay, now this is where it gets really interesting, especially for anyone watching the tech sector. Because the U.S. right now cannot afford for this AI bubble to implode. It just can't.
No, the momentum is huge.
Right.
And that bubble relies entirely on just endless, rapid building of data centers.
And those data centers need massive amounts of high-performance rare earth components, especially the refined magnets.
So to prevent a supply shock in those critical components, the U.S. did two things. First, they delayed this key 50% sanctions rule for 12 months.
The rule designed to stop foreign products with too much U.S. tech going to certain places.
Exactly. Designed specifically to hobble Chinese tech manufacturing. And second, they allowed a critical license approval so Chinese rare earths could be imported again.
So wait, the original intent of that rule? Blocking sales to blacklisted Chinese companies like Huawei or SMAC proxies?
Has essentially been put on hold, at least partially. This reversal allows those previously blacklisted entities, these proxies, to start buying critical U.S. chip-making gear again.
While at the same time, the U.S. is desperately scrambling to stockpile refined Chinese rare earths.
That's the picture. It's stark. The U.S. needs the rare earths now to feed the AI beast, so it eases restrictions. China uses that opening to stock up on the U.S. technology access it needs.
It really sounds like both nations are stocking up for a long war, technologically speaking.
It does. But the imbalance of weakness here is really pronounced. China controls 91% of the global refined rare earth supply.
Right, digging the raw stuff out of the ground is one thing.
But the refining, turning that dirt into the usable high-purity metals and magnets, that's the real bottleneck. And China dominates it.
And rebuilding that refining capacity domestically, it's not easy, is it?
It's incredible. That's the structural reality.
Wow.
That dependence is effectively the price paid for a soybean deal that doesn't actually fix the long-term problem for American farmers.
Wow. Okay, so let's pivot then. All this geopolitical maneuvering, these trade-offs, how does it connect back home? What does it mean for the domestic economy for you?
Absolutely. Because this all takes place against the backdrop of what might be the biggest pressing issue brewing right here in the U.S.
Yeah.
A really significant and kind of stealthy monetary policy pivot by the Fed.
All right, so how does this high-stakes global game affect, say, your household budget? We recently saw the Fed cut rates, right? 25 basis points. The target rate is officially below 4% now.
Yes, they did cut. And Chair Powell sort of signaled that further cuts, maybe in December, aren't guaranteed. He mentioned high tariffs and possibly rebounding inflation as reasons to maybe pause until 2026.
Okay, but you said the real story is quieter, something on the balance sheet side.
That's right. What's truly crucial to grasp here is the decision to effectively stop quantitative tightening, QT.
Okay, explain QT simply. What were they doing?
So, for the past couple of years, the Fed was trying to fight inflation by shrinking its massive balance sheet. It was selling off its holdings of U.S. Treasuries and mortgage-backed securities up to $100 billion worth per month.
Selling bonds.
Selling those assets pulls liquidity, pulls money out of the financial system. That's tightening, QT.
And now, what happens December 1st?
They stop. They stop reducing those bond holdings. They stop the sales.
So they stop pulling money out.
Exactly. By halting the sales, they stop actively removing money from the system. This is a huge kind of under-the-radar easing move. It's designed to stabilize a financial system that's definitely showing some cracks, partly because of these trade war pressures we've been talking about.
So this isn't just some abstract game in the bond market. The point of stopping QT is to lower borrowing costs, not just short-term rates, but longer-term ones too.
Precisely. Lowering those longer-end borrowing costs means, hopefully, cheaper mortgages, cheaper corporate debt, cheaper car loans. Things the Fed clearly thinks the economy needs help with right now.
Okay, if you're finding these insights useful, maybe take a second now to subscribe to Geo9. It really motivates us to keep sharing these research stories.
Definitely. Okay, so they're injecting stability, or trying to, by stopping QT, but they're also dramatically increasing the risk profile down the road.
How so? What are the risks here?
Well, you have to remember the enormous overhang of excess liquidity from the 2020 monetary expansion. There's still something like $3 trillion of that sloshing around in the U.S. economy.
Yeah.
It never really left.
That $3 trillion, that's the fuel for future inflation, right? And now the Fed is turning off the main tool they had to soak it up.
Exactly. Which leads to a deeply concerning question. What happens if, despite stopping QT, a major liquidity squeeze still occurs.
And there are reasons to think one might.
There are multiple potential black swans circling, aren't there? You've got the urgent, very expensive rush to onshore U.S. supply chains. You've got the risk of the AI bubble popping if funding dries up or demand falters. And you have the slow burn collapse of consumer spending, as months of tariffs and high prices drain household savings.
So if several of those things hit at once,
The consequences could be severe. If a major liquidity event gets triggered, the Fed will likely be forced to panic,
panic meaning.
meaning they have to monetize the debt, print money on an epic, almost unimaginable scale to prevent a systemic collapse.
Wow.
The analysis suggests that if that nightmare scenario unfolds, the crises of 2008 and 2020,
Yeah.
well, they might look like a relative cakewalk compared to the inflationary tidal wave that could hit the domestic economy.
Okay, so let's pull back and try to synthesize this.
Right, so the U.S. secured a temporary fragile win on soybean trade, but it sacrificed long-term strategic independence by effectively reversing key sanctions related to rare earths and critical chip technology access for China.
Okay.
And at the same time, the domestic financial system is being aggressively propped up by this stealth Fed pivot stopping QT, which actually risks making underlying inflation worse and could force catastrophic money printing later if things go wrong.
So we've seen short-term political needs, maybe election cycle needs, driving these huge decisions in farming, in technology access, in finance, all seemingly designed to just kick the can down the road, defer the real reckoning.
It certainly looks that way.
So if these fundamental structural weaknesses like farmers losing $100 an acre, or the absolute dependence on China for refined magnets if they can't be fixed without these massive infusions of temporary debt and risky economic concessions, here's the final question for you to think about. What event, whether it's domestic or international, will finally be the one that forces the U.S. to confront this fundamental underlying cost crisis across its entire economy? What do you think is the biggest vulnerability that we've uncovered today?
That's the multi-trillion-dollar question, isn't it?
Let us know your take in the comments below. We're really interested to hear your point of view. And yeah, if you haven't already, please subscribe to Geo9 so you don't miss our future insights.